You ever see those crazy financial headlines about market swings and just wonder, what does any of that have to do with the real world? Well, today, we're going to pull back the curtain and show you the hidden engine that connects it all. All right, let's dive in.
Yeah, we hear things like this all the time, right? It just feels like the financial world is in this constant state of chaos. It's a storm of data, expert opinions, and events you just can't predict. It's complex, it's volatile, and honestly, it can feel totally disconnected from our everyday lives.
And that is the million-dollar question, isn't it? How does a decision made by a few people in a boardroom in Washington, D.C. affect the actual bricks of a building or the engine inside a machine? In this explainer, we're going to connect those exact dots.
Okay, so first things first. Let's start by looking at those big, noisy forces that seem to dominate all the headlines. These are the things that create the whole environment that every single business has to operate in.
You know, it really just boils down to a handful of key factors. You've got geopolitical risks, like trade wars or international conflicts, that create a ton of uncertainty. Then you have the big one, central banks, like the U.S. Federal Reserve, making these huge decisions on interest rates. Throw in the pressure of inflation and how much people are spending, and boom, you've got the perfect recipe for a volatile market.
Now let's just push all that noise to the side for a second. We're going to zoom way, way in, past the abstract market and down to the concrete foundation of any business.
Seriously, think about it. Forget the stock ticker. Forget the news headlines for a minute. What are the core physical things that let a business actually operate, make things, and grow year after year? The answer? Well, it's the key that unlocks this whole puzzle.
And here it is. It's called a fixed asset. That's the official term, but basically, it's all the long-term tangible stuff a company owns to actually run its business. This isn't stuff they're planning to sell off quickly. These are the tools they use to make money for years to come.
And these examples make it super clear what we're talking about. We mean the literal factory buildings, the machinery on the assembly line, the whole fleet of delivery trucks. Heck, even the computers and desks in the office. These are the real physical workhorses of the economy.
Okay, here's a great way to think about it to make the distinction crystal clear. For a real estate company, the office building where all the agents work every day, that's a fixed asset. It's their home base. But the houses and apartments they have listed for sale? Totally different story. Those are current assets because the whole point is to turn them into cash, and fast. So it's the same item, a building, but a completely different purpose. Okay, so we've got the chaotic market over on one side and a company's actual physical machinery on the other. So how in the world do we build a bridge between them? Well, let's trace the chain of events.
A lot of the time, the whole chain reaction kicks off right here with a decision by the central bank. To try and cool down inflation, the Fed makes a move to raise its main interest rate. And you got to understand, this is one of the most powerful economic levers on the entire planet. The immediate effect is that it just gets more expensive for everyone to borrow money. All of a sudden, taking out a loan to fund a new project has a higher price tag. And that's true for every business, from a tiny startup to a massive corporation. And this, right here, is the connection we've been looking for. When money gets more expensive to borrow, what's the first thing companies cut back on? The big, long-term investments. They hit the brakes on buying that new fleet of trucks or building that new factory. In other words, they stop investing in their fixed assets. And that's a huge deal for us, because it can mean hiring freezes, fewer new jobs, and a slowdown in the new products and services we all use.
And listen, this isn't some abstract theory from a textbook. The Fed recently held interest rates right in this very range, which sends a massive signal to the entire market about what it costs to borrow. That single decision sends ripples through the whole economy, influencing everything from hiring decisions to major expansion plans.
So, now that we see the connection from the Fed all the way down to a company's machinery, let's zoom back out, because this chain reaction doesn't just stop with businesses. It dramatically changes how investors decide where to put their money.
If you're an investor, you've got this fundamental choice between two main camps. On one side, you have fixed income. Think government bonds, which is generally safer and more predictable. On the other side, you have variable income. That's stocks, which offers way more potential for big returns. But it also comes with a lot more risk. The economic climate we've been talking about, it has a huge influence on which path investors are going to take. During these really uncertain times, when the Fed is making big moves and there's geopolitical tension, a lot of investors don't just choose between stocks and bonds, they run for cover. And that cover has a name. It's called a safe haven asset. And these are the classics, the usual suspects. You've got gold, which has been seen as a store of value for centuries. You have U.S. Treasury bonds, which are backed by the full faith and credit of the U.S. government, so they're seen as incredibly secure. And even the U.S. dollar itself tends to get stronger as investors look for stability. Basically, when fear goes up, money flows into these assets.
So, let's put all of these pieces together and look at the whole picture. We've journeyed from those global headlines down to a single piece of machinery and then back out to investor strategy. Let's just recap the entire flow. It's really a four-step cascade. First, the big macro forces, Fed policy, geopolitics, create volatility in the market. Second, that directly impacts how much it costs for companies to borrow money. Third, companies react by changing their spending on long-term fixed assets. And finally, investors see all this happening and react by shifting their money around, looking for that balance between risk and safety.
Ultimately, this is why it all matters so much. It's not about being able to predict the future. It's just about understanding the mechanics of how this machine works. Knowing how these pieces connect lets everyone, from business owners to regular investors, make smarter, more informed decisions in a really complex world.
And that leaves us with one final thought to chew on. We can see how a single decision can ripple across the entire globe, linking monetary policy to physical machines to financial portfolios. It really makes you wonder, in a system that's this interconnected, what does a truly safe investment even look like anymore? Something to think about.